Hello everybody and welcome to our video covering the qualitative characteristics of accounting information. So to start things off here, we have to talk about information, accounting information and really any information. Why is it useful? How is it useful? The purpose of information, the usefulness of information from an accounting perspective is that it has to be useful in making decisions, also known as decision usefulness. So the point is, some parties, internal, external, whoever, are going to be using this information to make decisions. Again, there are a variety of decisions that would be made. We're just talking generally here. Now, some of this data is historical data, just a collection of the historical data. Some of it is future predictions based on the historical data and any just expectations of the future. But to be useful in making decisions, somebody needs to be able to trust and rely on that information. They need to be able to get the information quickly and easily, and it needs to be in a format you can read and understand. Now, before we even get into this hierarchy of accounting qualities, these kind of set the stage for what we're talking about. I think most people would agree that for information to be useful in making decisions, it has to follow these general rules. Now, from an accounting perspective, from the FASB.org, Financial Accounting Standards Board, in SFAC, Statement on Financial Accounting Concepts number 2, they've actually laid out the information, the qualities that accounting information must have in order to be useful in making decisions. Now, this is a fairly in-depth slide, and this comes straight from the FASB.org website, and it's straight from SFAC2. But the idea is the users of accounting information are going to be a variety of internal and external parties, all of that. Now, we talk about a pervasive constraint. This is known as the cost-benefit analysis. So the idea here is that the cost of generating the information should be less than the benefits that the additional accuracy of the information will provide. So we'll talk more about that later. It really closely relates to materiality on the bottom side here. The first thing is that information must be understandable. Before it can be useful at all, it has to be understandable. You have to be able to read it, interpret it, understand it. Now again, we're not saying anybody off the street can pick up a financial accounting statement and understand what's going on, but somebody with a reasonable level of expertise and knowledge should be able to understand it. That's the point there. So then we get to decision usefulness. We get to this little tree that we're going to spend most of our time talking about in the later slides. We have two primary qualities here, relevance and reliability. I will say that in different textbooks, different graphs, sometimes they refer to reliability as this representational faithfulness, so that shows up here instead. I really like the original verbiage, relevance versus reliability. In order to be useful in making decisions, the information has to be relevant to that decision, and it has to be reliable. You have to be able to trust it. So when we get to relevance, the ingredients of relevance is that it has to have either predictive and or feedback value, and we'll talk about what those are later on. And to be relevant, it has to be given to you in time to make the decision. If it's given to you 2 years after the fact, that information is worthless. So it needs to be relevant, it needs to be timely. Now, for reliability, it has to be verifiable. You have to be able to have an auditor or somebody else check that information and see if they agree with it, see if they've recalculated it, all of that. It has to be neutral, free from spin, and again, it has to have representational faithfulness, which is really just another phrase for reliability, but what it's basically saying is it has to faithfully represent what it purports to represent. It's telling you the truth about what it's trying to describe. So it's painting an accurate picture of how things were. A secondary quality is that it has to be comparable. So you have to have comparability, and it leads to consistency. The two go hand in hand. Again, we're going to see what each of these are in just a bit. At the very bottom here, they have the threshold for recognition materiality. Before anything is recorded, no matter how good the information might be, it has to be material, which again so closely ties to that cost-benefit constraint. We're not going to spend millions and millions and millions of dollars to get slightly more accurate information that's not really going to matter to anybody's decision making to begin with. So now let's go through each of those pieces in a little more detail and talk about them. Again, this comes from the SFAC number 2, and the first one was relevance. So predictive value is basically the ability to take information about the past and predict what we think might happen in the future because of that. What costs do we think they'll have? What revenues do we think they'll have? All of that. It's predictive value. Feedback value is information that after the fact allows us to determine whether or not a prediction was true or not. So the reason that's so important is that it allows us to change our decision making, our prediction models for the future. We need both predictive and eventually feedback value. Again, timeliness, such a key thing there. Information can be the best information in the world. It could be used to predict things in the future. But if you don't get it until well after the fact, it's too late to predict something because it's already happened. And your window of opportunity for your investment or your decision is passed. So timeliness is very important. Then we move on to the reliability / representational faithfulness. I explained earlier what representational faithfulness means. But we have verifiability, which again, generally speaking, we're talking about the auditor having the ability to go in because they have access directly to the company's books. They have the ability to go into those books and recount inventory, re-examine procedures, evaluate the bank reconciliation, just redo things, just a sample obviously, not everything, and they should be able to come up with the same final results that the company did in their accounting. Generally, an external user wouldn't be able to do so just because they wouldn't have all the detail they need for it. And we get to the other element of reliability, which is neutrality. For you to be able to rely on something, you have to not have a concern that somebody is so close to that company that they're lying to you or giving a spin on that information to protect the company. You want the absolute truth, nothing being concealed, anything like that. You want somebody with a third party that's independent, like an auditor, to be able to give that stamp of approval that the information is true. So we talked about comparability and consistency going hand in hand. And the reason for this, comparability, well, let's go with consistency first. This basically means that the company is using the same basic measurement techniques, same accounting measurements from year to year, so that when you take a look at 2-year statements, obviously you're going to see different numbers, but they were all calculated the same way. So that means you could tell with accuracy, does this company truly have more revenues? Have they earned more money this year? Or was it just an accounting trick? Was it just a different way of recording revenues? If they're consistent with their principles, you can more easily compare the financial statements from year to year. Now, this is one of those soft rules, and if they don't follow it, if they do change their principles, which they do have the ability to do, they have to be very clear of what principle they used before, what principle they use now, why they changed it, and in most cases they even have to go back and restate the earlier statements under this new rule now so that you can easily compare them. You don't have to do the work yourself. Understandability we talked about. Yes, you need to have a reasonable level of experience and knowledge about accounting and about that industry, but in that case it should be understandable. One of the things that came out of the all the scandals around the early 2000s, especially Enron in this case, was that a lot of the accounting tricks they were using, the goal was simply to make things so overly complex that even an experienced professional would take a look at it. They wouldn't understand it necessarily, but they'd be almost embarrassed to ask a question. They'd feel like, hey, I should know this, so I'm not going to speak up and ask the question because they might have thought it was a dumb question. In reality, the things were just so overly complex as an attempt to hide the truth. So they need to be understandable. And finally, we talked about the cost, benefit, and materiality constraints. Again, you don't want to spend all that extra time and effort to get slightly more accurate information if nobody's going to benefit from that information. Materiality means that you don't look for every penny. You find out what a reasonable threshold is that would impact somebody's decision, and you make sure that at least up to that point you are accurate within reasonable assurance. So that takes us through our discussion of the qualitative characteristics of accounting information. Just a quick ending slide showing some information on where to find more videos that I've created. I have my YouTube channel here. You can just Google for Severson Accounting YouTube. I will post a link of my videos on Dropbox. I have an Excel spreadsheet there. I'll post that to this video so you can see that as well. If all else fails, you could post a comment to the video and I can respond to you with that link. So thank you for your time. Have a great day.